Hello, my name is Rhonda Rode. I'm one of the pension plan consultants for the Cooperative Superannuation Society, or CSS Pension Plan. It's my pleasure to be with you to share some information about the CSS Pension Plan. The CSS Pension Plan is one of the oldest and largest defined contribution pension plans in Canada, with about $5 billion in assets. We originated in 1939 at the Co-op Refinery. Over the years, other cooperatives and credit unions joined the plan. So we are a pension plan for cooperative and credit union employers and their employees. Today, some 80 years later, we've grown to serve over 300 employers and more than 50,000 current and past cooperative and credit union employees across 8 provinces and territories, including more than 8,000 retirees receiving a retirement income directly from the CSS Pension Plan. Today's webinar focuses on items of interest for late career employees. In the webinar, we will be discussing the federal programs available to you in retirement along with the personal savings you may have. We will discuss your CSS member account along with our monthly pensions option and our variable benefit payment option. We will also talk about investment choice decisions as retirement approaches. Then we will chat about some of the services we offer to help you get ready for retirement. When it comes to retirement planning, there is no one-size-fits-all approach in terms of how much retirement income you'll need. People retire at different ages, with different amounts of savings, and with different goals in mind. No two retirement journeys are exactly alike. However, there are some helpful concepts to think about that can provide general guidelines with respect to what your main sources of retirement income might be and what your spending may look like as you progress through retirement, namely the three-legged stool concept. We use the stool metaphor for the sources of retirement income because it conveys the notion that you will need to look at all 3 legs when trying to balance your retirement income plan. Tinkering with one leg without considering the other 2 may leave your retirement income plan unbalanced. Your sources of retirement income will include federal programs, your personal savings, and your CSS pension plan, along with any other registered pension funds you may have. We will begin by looking at the first leg of the stool, federal programs. This is mostly comprised of the Canada Pension Plan and Old Age Security. We will start with providing a general overview of the Canada Pension Plan, also known as CPP. CPP provides contributors with a partial replacement of their earnings in retirement. The CPP program began in January of 1966. The amount of your CPP retirement pension will depend on how much and for how long you and your employer contributed to CPP and your age when starting to draw on your CPP retirement pension. Something to keep in mind is that income tax is not automatically withheld from your CPP retirement pension. Be aware of this so you don't wind up with an unexpected tax bill when you file your tax return. To help avoid this situation, you can request to have income tax withheld in whatever amount you like. You do need to contact Service Canada to apply for your CPP retirement pension and to have income tax withheld. We will provide contact information for Service Canada in a few slides. The full CPP retirement benefit may be received if taken at age 65. As you can see, the maximum CPP retirement pension is $1,203.76 per month for 2021. Keep in mind, in order to receive this maximum benefit at age 65, you would have had to have earned at least the annual YMPE, which stands for Yearly Maximum Pensionable Earnings, each and every year of your contributory period between age 18 and 65. The YMPE for 2021 is $61,600. Not everyone receives the maximum CPP retirement pension. In fact, the average CPP retirement pension is about half the maximum, or about $600 per month. CPP is indexed annually based on the increase in the average industrial wage. As indicated in the previous slide, you could receive the maximum CPP retirement pension at age 65 if you contributed the maximum throughout your contributory period. However, you can start your CPP retirement pension as early as age 60 with a permanent reduction of 0.6% for each month you're younger than age 65. Or you can delay starting your CPP retirement pension until as late as age 70 and receive a permanent increase of 0.7% for each month you're older than age 65. As you can see, if you start at age 60, you will have a permanent reduction of 36%, or if taken at age 70, you would have a permanent increase of 42%. We have an article on our website entitled "When is the best time to start CPP payments?" which was written by our Executive Director Martin McInnes. When to start CPP will depend upon your individual situation. The article is an in-depth discussion on the various complexities to this question. I would encourage you to go to the 2018 news section of our website and read this article. Now let's have a look at Old Age Security, also known as OAS. The OAS pension is a monthly benefit for Canadians over age 65. OAS is paid to all Canadians, whether they were in the workforce or not, but it is subject to certain citizenship or residency requirements. To receive the current full OAS pension of $615.37 per month, you must have been a Canadian citizen or resident for at least 40 years after age 18. To receive a prorated portion of the OAS pension, you must have been a Canadian citizen or resident for at least 10 years. The OAS pension is indexed quarterly based on inflation. Like CPP, income tax is not automatically withheld, so you need to plan for that or contact Service Canada to have income tax withheld. If your individual net income exceeds a certain amount, your OAS pension is subject to a 15% repayment or clawback. The OAS pension starts to be clawed back at a net income level of $79,845 and is totally repaid if net income exceeds $129,075. Net income is the amount you report on line 236 of your income tax return. If you do not want to start your OAS pension at age 65, you can delay starting it up to age 70. If you delay starting your OAS, you will receive a permanent increase of 0.6% for each month you are older than age 65, up to a maximum increase of 36% if you wait until age 70. You cannot start your OAS pension before age 65. If you have any questions about CPP and OAS, here is the contact information for Service Canada. The second leg of the stool that we will be discussing is comprised of personal savings you may have. Personal savings consist of investments or savings you have with credit unions and other financial institutions. These will consist of any money that you have in registered retirement savings plans or RRSPs, tax-free savings accounts or TFSAs, and any regular non-registered savings accounts or investments. Registered retirement savings plans or RRSPs are a type of personal savings vehicle that allow you to save income tax when you contribute to them, but any withdrawals from them are taxable. So ideally, you wouldn't want to make any withdrawals from your RRSPs until you're retired. There are limits on how much you can contribute to an RRSP. You can check your Notice of Assessment from Canada Revenue Agency for your RRSP contribution limit. Tax-free savings accounts, or TFSAs, have been around since 2009. Unlike RRSPs, you do not receive a tax deduction for your contributions to a TFSA, but the withdrawals are not taxable income to you. The interest or earnings generated from the investments for your TFSA accumulate tax-free. There are limits on how much you can contribute to a TFSA. Your contribution limit is indicated on the Notice of Assessment from CRA. Last but not least are the regular or non-registered savings vehicles, such as savings accounts, guaranteed investment certificates or GICs, and term deposits. With these products, there are no limits on how much money you can put in, nor are there any special tax breaks on the contributions or investment earnings, and the withdrawals are not taxable. These three personal savings vehicles are the typical components of the second leg of the retirement income stool. The third leg of the stool is comprised of workplace pension plans for those of us in Canada fortunate enough to work for an employer that provides one, like our own CSS Pension Plan. Currently, only about 40% of Canadians belong to a workplace pension plan, so we are very fortunate to belong to one. The principal purpose of the CSS Pension Plan is to provide you with a retirement income with the funds you have accumulated in your account in the pension plan. Your pension funds are a combination of contributions you have made, plus contributions your participating employer has made on your behalf, and accumulated investment earnings thereon. The CSS Pension Plan is a defined contribution pension plan, or sometimes referred to as a money purchase pension plan. So the more funds you accumulate in the plan, the more will be your retirement income. The factors that will determine how much you accumulate in the plan are the amount you and your employer contribute to the plan, the rate of return on those contributions, and how long the contributions are invested. Generally, your account balance grows over time, so delaying your retirement tends to increase your retirement income. Early retirement under the CSS Pension Plan is age 50, or can be earlier than that if your age plus years working service equals 75 or more before you turn age 50. Check your annual statement for your early retirement age. Or you can delay the start of your retirement income with your CSS Pension Plan funds up until the end of the year you reach age 71. As a registered pension plan or RPP that is a defined contribution pension plan, the Canada Revenue Agency sets a limit on how much can be contributed to the CSS Pension Plan. As an active member, which is someone who is working for an employer member and contributing to the plan, the maximum you and your employer can contribute combined in 2021 is the lesser of 18% of your current year's employment earnings and $29,210. If you and your employer are not contributing up to your contribution limit, you can make extra or additional voluntary contributions to take you up to your limit, if you wish. You would arrange this through your employer's payroll department so that the extra contributions are deducted off your paycheck and remitted to the pension plan each pay period. If you decide to make additional voluntary contributions, you can turn them off and on whenever you like, but you cannot access them until you are no longer working for any employer member of the CSS Pension Plan. Please keep in mind that your contribution limit to the pension plan is separate from your RRSP contribution limit, and you cannot use your RRSP contribution room to make extra contributions to the pension plan. Also, if you do not contribute the maximum to the pension plan in any 1 year, that unused room is not lost. It will become part of your RRSP room in the following year. Your contributions to the plan are tax deductible, so that saves you income tax. You must convert your funds in the plan to a retirement income sometime before the end of the year you reach age 71. The retirement income you receive from your pension funds is fully taxable. Most of the funds, if not all the funds in your account, are going to be locked-in funds. According to pension legislation, locked-in funds must be used to provide retirement income. The options for a retirement income from the CSS Pension Plan are a traditional monthly pension, which is an annuity-type payment, or our variable benefit payment option. If you wish, you can transfer your pension funds out of the plan at retirement and receive an annuity from an insurance company or a life income fund, or LIF, or a prescribed RIF or PRIF from a financial institution. If you're going to have any non-locked funds in your account, it will likely be as a result of you making or have made additional voluntary contributions or AVCs. You can access these funds as a lump sum, subject to income tax, or as a transfer to an RSP with another financial institution. Or, when you are retiring, you can use them for a retirement income, such as a monthly pension or VB payment from the pension plan, or transfer them out and get an annuity from an insurance company or a RIF from a financial institution. Please note that any non-locked-in funds you may have in your account are only accessible once you are no longer working for an employer member of the pension plan. What happens to your pension funds when you pass away? There's two possible situations. You either pass away before you convert your pension funds to a retirement income, or you pass away after you convert your pension funds to a retirement income. If you pass away before retirement, your surviving spouse has first claim to your pension funds, regardless of what your designation of beneficiary form or will might say. This is in accordance with pension legislation. See the designation of beneficiary form on the forms page of our website for the different provinces' definitions of spouse. Your surviving spouse can leave the funds in the plan until further notice and receive the same return as all other members, and then access the funds at a later date. Or your surviving spouse can access the funds immediately. If there is no surviving spouse, or your spouse has signed a prescribed waiver form waiving their rights to their claim on your pension funds, then your pension funds would be payable to your designated beneficiaries or estate as a taxable lump sum. If you pass away in retirement, the survivor benefits depend on which retirement income option or options you select when you retire. The CSS Pension Plan is one of the oldest defined contribution pension plans in Canada and one of the few that offers its own internal retirement income options. In other words, with the CSS Pension Plan, you do not have to transfer your funds out of the plan at retirement. You can if you want to, but you don't have to. Members of many other defined contribution plans must transfer their funds out at retirement, but not so with the CSS Pension Plan. In the interest of time, we will only discuss the retirement income options available with the CSS Pension Plan and not those also available from other financial institutions. The first option we are going to look at is the traditional monthly pension or the annuity type payment. You can convert some or all of your locked-in funds and non-locked-in funds into a pension. The pension option will provide you with a fixed monthly income for your lifetime. It's important to keep in mind that once you start a monthly pension, you cannot make any changes to it. It is set for life. The CSS Pension Plan has been offering its own monthly pension since 1972. The first monthly pension option is the single life pension. A single life pension will only provide a lifetime pension to you. It does not provide a lifetime pension to your surviving spouse if you have a spouse. Single life pensions can have guarantee periods of 0 years, which is no guarantee, 10 years, or 15 years. The longer the guarantee period, the lower your monthly pension payment will be. A single life pension with no guarantee period, or 0 years guarantee, will provide a lifetime pension to you for as long as you live. However, once you pass away, the pension stops. In other words, the pension dies with you. A single life pension guaranteed 10 years or 15 years will provide a lifetime pension to you for as long as you live, but it is guaranteed to be paid for at least 10 or 15 years depending upon your choice. If you pass away before the guarantee period expires, your pension will continue to be paid to your beneficiaries or estate for the balance of the guarantee period. If you outlive the guarantee period, you still get the pension for your life, but there would be no payments to your beneficiaries or estate upon your death. Assume, for example, that you select a single life pension with a 15-year guarantee period. In our example, that would be $399 per month. You would receive this amount for as long as you live. If you were to pass away 7 years after your pension starts, the monthly pension of $399 per month would be continued to be paid to your beneficiaries or estate for 8 years until the 15-year guarantee period expires, and then the pension would stop. However, if you are still alive when the 15-year guarantee period expires, you still get the $399 a month for the rest of your life, but there would be no survivor benefits upon your death. Our next pension option is the Joint and Last Survivor Pension. A joint and last survivor pension will provide a lifetime pension to you, and after your death, your surviving spouse will receive a lifetime pension as well. Joint pensions pay less than the single life pensions because they cover 2 lives, yours and your spouse's. Joint and last survivor pensions can be guaranteed for 10 years or 15 years. If both you and your spouse die before your selected guarantee period expires, the pension will continue to be paid to your beneficiaries or estate for the balance of the guarantee period. The longer the guarantee period, the lower the monthly pension. Suppose, for example, that you select a 15-year guarantee period and both you and your spouse pass away after 6 years after your pension starts. In that case, the full monthly pension would continue to your beneficiaries or estate for 9 years. Then the pension would stop. With a joint and last survivor pension, there are also different spousal benefit percentages to choose from, which is the amount of the pension that your surviving spouse receives after the guarantee period is over. The spousal benefit percentages are 60%, 75%, and 100%. For example, assume that you and your spouse select a joint and last survivor pension guaranteed 15 years with a 75% spousal benefit level. So in our example, you will receive $360 monthly for the rest of your life. If you die before the 15-year guarantee period is over, your surviving spouse would receive the full $360 monthly for the balance of the 15-year guarantee period, and then they would receive 75% of the $360 for the rest of their life. If you die after the 15-year guarantee period is over, your surviving spouse would immediately receive 75% of the $360 for the rest of their lifetime. Once the guarantee is over and both you and your spouse have passed away, the pension stops. Note that if you and your spouse select the 100% spousal benefit level, your spouse will receive 100% of the monthly pension for the rest of their lifetime, regardless of when the guarantee period ends. All factors being equal, the older you and your spouse are when you start your pension, the higher your monthly pension payment will be. The other retirement income option available from the CSS Pension Plan is the Variable Benefit Payment, or VB payment option. As we'll see, variable benefit payments are not at all like a monthly pension. VB payments is a relatively new option, as it's been available since 2006. VB payments are simply periodic withdrawals from your CSS Pension Plan account. The withdrawals can be set up as monthly or annually. VB payments are not at all like a monthly pension. In other words, VB payments will not guarantee you a fixed monthly payment for as long as you live. With VB payments, you set the amount of your payments within some limits, and you can change your payments from time to time if you want. Because the pension funds remain in your account, you are still responsible for deciding on how those funds are to be invested among the plan's 4 investment fund options. These are the same investment fund options that are available to you today. Also, just as is the case today, if you like, one of the CSS Pension Plan consultants can assist you with these investment decisions. In accordance with Income Tax Act regulations, there is a minimum annual withdrawal for VB payments, but it doesn't start until the year you turn 72. So until that time, minimum annual withdrawal is 0. The minimum annual withdrawal percentage increases each year as you get older. If you have a spouse and they are younger than you, you can have the minimum withdrawal percentage based on their age, which would then make the minimum payment calculation less than if it was based on your own age. You can set up VB payments on both your locked-in funds and your non-locked-in funds. Provincial pension legislation in BC, Alberta, and Manitoba sets a maximum payment on the locked-in funds. So there is a limit on how much you can withdraw each year from BC, Alberta, and Manitoba locked-in funds. There is no maximum payment under Saskatchewan pension legislation, and there is no maximum payment on the non-locked-in funds under any pension legislation. No maximum payment essentially means you can spend the funds as quickly as you like. With VB payments, you can temporarily stop your withdrawals if you want, up until the end of the year you turn 71. As already mentioned, you can change the amount of your VB withdrawal. For example, you might want higher VB payments in your early years of retirement, subject to any maximum imposed on your locked-in funds, and somewhat lower withdrawals later on. You also have the option to convert all or a portion of your VB funds to the traditional monthly pension option later on if you wish. With VB payments, whatever funds remain in your account upon death will go to your heirs. Your surviving spouse has first claim to your funds upon your death. The pension funds roll over tax-free as a lump sum to your surviving spouse, and then he or she receives VB payment withdrawals at whatever amount they wish, which are taxable to your surviving spouse in the year received. If you don't have a surviving spouse, or your spouse has signed a form to waive their right to first claim status to your funds, then any remaining funds upon your death are paid to your beneficiaries or estate as a taxable lump sum. So if leaving any unspent funds to your heirs is important to you, the VB payment option certainly addresses that issue for you. As already mentioned, the VB payments are simply periodic withdrawals from your CSS Pension Plan account. Since your pension funds remain in your account, they need to be invested. The investment fund options available to you are the same ones that are available to you today. The same balance fund, bond fund, equity fund, and money market fund. As you get closer to retirement, there are a number of things you need to consider, such as how much retirement income are you going to need? Do you have enough saved to provide the retirement income you're going to need? And what type of retirement income are you going to choose? A traditional monthly pension or a variable benefit payment? Depending on which retirement income option you are planning to take, there are different strategies that you should consider regarding how you might restructure your investments as your retirement approaches. Generally speaking, if you are more than 3 to 5 years from retirement, you probably still need more growth in your pension fund savings, so you should stay invested in the balance fund or some combination of the equity fund and the bond fund. If you are less than 3 to 5 years from retirement and you plan to take a traditional monthly pension, then at retirement you will be exiting the markets with your pension funds. Therefore, in order to protect or preserve your pension funds from a possible negative return before your pension starts, you should consider gradually shifting your pension funds into less risky investment funds, such as the money market fund and/or the bond fund, as you wouldn't necessarily have time to recover from a negative return before your pension starts. For example, if you are 3 years from retirement, you might consider transferring a third of your pension funds from the balance fund into the money market fund and/or bond fund. Then the next year you would transfer over another third, and then 1 year before you start your pension, you would transfer over the final third of your pension funds. Using this strategy, you are averaging out of the investment markets into safer, less risky investments. If you are less than 3 to 5 years from retirement and planning on our variable benefit option, you'll want to stay in the markets with a good portion of your pension funds, as you will still have a long investment horizon in your retirement of 15, 20, 25, or maybe 30 more years of retirement. You can stay in the markets by investing in the balance fund or some combination of the equity and bond funds. By staying in the markets, you would expect a higher long-term average return and reduce the impacts of inflation. You should also consider investing some of your pension funds in the money market fund for a spending reserve. The CSS Pension Plan suggests having 1 to 3 years of withdrawals in the money market fund, and that when you retire, you make your variable benefit withdrawals from the money market fund. Then each year, when markets perform well, you would replenish the amount you withdrew from the money market fund from your investment in the markets, such as the balance fund. In the years when the markets don't do well, you would not transfer out of the balance fund to replenish the money market fund. You would still have funds left in the money market fund to pay you your retirement income and leave the balance fund alone to let it recover. Once the markets recover, you would then replenish the money market fund by transferring from the balance fund. Let's go through an example of how some members use the money market fund for their spending reserve. Let's say we have a member who has decided they want a spending reserve of 2 years worth of variable benefit withdrawals in the money market fund, and their retirement plan indicates their withdrawal is going to be $1,000 per month. So this member is going to have $24,000 in the money market fund at retirement for their spending reserve. When they retire, they set up their monthly variable benefit withdrawals to come from the money market fund. Then, after a year has gone by, they look at how their balance fund investment has done, and let's say the markets were good and the balance fund had a good return, so they replenish the $12,000 withdrawn from the money market fund by transferring $12,000 from the balance fund to the money market fund. So they are now back to having 2 years worth of withdrawals, or $24,000 in the money market fund. Now another year goes by with $1,000 coming out of the money market fund each month. And let's say this past year the markets were down and the balance fund had a negative return. Not to panic, because we still have $12,000 left in the money market fund, or 1 year's worth of retirement income, so we can leave the balance fund alone and let it recover. By using this spending reserve strategy, it helps to avoid being forced into the situation of having to take money from the balance fund when markets are down. In other words, selling low. Ideally, we want to take the money from the balance fund when the markets are up, or sell high. This is not guaranteed to work all the time. It could break down if we had multi-year downturn where we see negative market returns for an extended period of time. We suggest you start establishing your spending reserve when you're 3 to 5 years from retirement by transferring a portion of your pension funds from the balance fund each year into the money market fund, so that when you retire, you have your desired 1 to 3 years worth of retirement income in the money market fund. Also, keep in mind that with the variable benefit option, your annual investment returns will fluctuate from year to year, so you should be prepared to adjust your variable benefit withdrawals accordingly. If you want to change how your funds are invested in the CSS Pension Plan, please be advised that you can now submit investment instructions online through the My CSS Pen portal at no charge. You might want to review your investment instruction decisions with a CSS Pension Plan consultant or a qualified financial advisor to ensure it is consistent with your plans for retirement. More investment choice information can be found on our website. While every investor wants to buy low and sell high, it's easier said than done. If it was easy, we'd all be rich. Moving money in and out of the markets in an attempt to beat the market is called market timing. Stock markets can move without warning and by large amounts in response to unforeseen events. This slide demonstrates the dangers of market timing. It shows that it's time in the markets, not timing the markets, that leads to long-term success. Here we are going to look at $10,000 invested in the US S&P 500 stock market index for the 15-year period from December 31st, 2003 to December 31st, 2018. If you were fully invested in the S&P 500 for the entire 15-year period, which includes 2008 when the S&P 500 lost close to 40%, your $10,000 investment would have grown to over $30,000. This translates into an annualized return of 7.8%. However, if you missed only the 10 best trading days of the 15-year period, your $10,000 would have only grown to about $15,500 over the 15-year period, or a 2.96 annualized return. If you missed the 20 best trading days, you didn't make any money during that 15-year period. If you missed the 30 best trading days, your $10,000 is only worth about $6,800 15 years later. And if you missed the 40 best trading days, your $10,000 is worth less than half as much. It's important to note that these best trading days typically happen just before the market highs and right after the market lows. Since we don't know when these highs and lows are until a number of months after the fact, someone who is trying to time the market is going to miss some of the best trading days, and that is going to affect their overall return. So again, it's time in the markets, not timing the markets, that leads to long-term success. Let's talk a bit about investment management fees. These fees are typically referred to as the management expense ratio, or MER, for investment funds such as mutual funds from financial institutions and the CSS Pension Plan's investment funds. The MER is an embedded fee that is essentially deducted from the investment's gross return to arrive at the net return you receive as the investor. Over the years, these fees can have a significant impact on your investment. If you look at the left side of the slide, you can see that in 2020, the MER for the CSS Pension Plan's balance fund was 0.43%. This compares very favorably with the median balanced mutual fund in the retail market, whose MER was 1.94% in 2019, according to Morningstar Fund research. Now have a look at the right side of the slide. Let's do a hypothetical illustration. Assume we have two investment funds that both have a gross return of 6% a year for 25 years, and one fund has an MER of 0.43%, so its annual net return is 5.57%, and the other fund has an MER of 1.94%, making its net return 4.06% each year. If someone invests $300 per month for 25 years, they'll accumulate over $191,000 in the fund with an MER of 0.43% and just over $154,000 in the fund with the MER of 1.94%. The difference of almost $37 is because of the difference in fees. Let's do another illustration. Again, as we discussed in the previous slide, if we have two investment funds and both have a gross return of 6%, but one has an MER of 0.43% and the other has an MER of 1.94%. The fund with the 0.43 MER has a net return of 5.57%, while the other fund with the 1.94% MER has a net return of 4.06%. But now let's have a look at the impact of MERs in annual dollar terms. If you have an investment of $100,000, it will cost you $430 in fees for the year if the MER is 0.43%. But if the MER is 1.94%, it will cost you $1,940 for the year for the same $100,000. That's a difference of $1,510 in fees on $100,000. Remember that these MERs happen each and every year, so over the course of saving for your retirement and in your retirement, the impact of fees can be very significant. In our illustration, this difference could potentially be over $15,000 in a 10-year period. The chart on the right shows the MERs of the CSS Pension Plan's investment funds compared with the median mutual fund MERs for 2019 according to Morningstar Fund research. Okay, let's chat a bit about some of the services we offer to help you get ready for retirement. The first is My CSS Pen member portal. The My CSS Pen portal allows you to access information about your CSS Pension Plan account online. You can check the value of your account balance, access your annual statement, make investment changes, update your contact info, access various tools and calculators, such as those for pension projections and variable benefit illustrations, view transactions, and check to see if your beneficiary designation is current. As time goes on, we will be expanding the features of My CSS Pen. Have you ever wondered how much income you will need each year in retirement? The answer to that question is, it depends on how much you're going to spend. So, do you know how much you'll be spending on housing, food, and other necessities? And what about leisure and recreational activities you plan to do in retirement? What will those cost each year? Besides the retirement assets you are accumulating in the CSS Pension Plan, you may have other sources of retirement income available to you, such as CPP and old age security at age 65. You may also have some savings in RSPs or TFSAs and other investments or savings. Remember the three-legged stool. If you have a spouse, they may belong to another pension plan or to the CSS Pension Plan, or have RSPs, TFSAs, and so on. So what you have in the CSS Pension Plan is just one piece of the puzzle. It might be a big piece, but it's still just one piece of the puzzle. These are all important considerations, so knowing how much you're going to spend in retirement will determine how much retirement income you're going to need. And knowing how much retirement income you're going to need will help determine if or when your nest egg in the CSS Pension Plan is large enough to support your retirement income needs along with the other pieces of the puzzle. Once you know the required asset level for your CSS Pension Plan nest egg, you can assess whether you are on track to achieve it. And once you have that plan in place, you can monitor it annually or more frequently to ensure you are staying on track as market conditions and/or your personal circumstances change. We believe that everybody needs some sort of plan for their retirement. Our online basic retirement planner is another one of the tools and calculators available to all members through the My CSS Pen area of our website. This retirement planning tool can help you determine if you're on track to receiving your goals or not. If you haven't tried it yet, we encourage you to do so. Some articles on our website that you may find interesting are the Career Timeline article and the Saving for Retirement in Your 20s, 30s, 40s, and 50s. Both articles shed some insights on planning for retirement regardless of what age you are. We also conduct in-person retirement income options or REO workshops. Check our website for the schedule. However, given the current pandemic, we do not yet have any such workshops scheduled for 2021. We do, however, have online versions of the REO workshop accessible from our website. The REO workshop goes into a lot more detail than this webinar regarding all the retirement income options and considerations for someone who is nearing retirement. And don't hesitate to reach out to one of our pension plan consultants. Perhaps you'd like some pension projections or variable benefit illustrations as you approach retirement, or you might want to discuss restructuring your funds in the plan as retirement approaches. This concludes our webinar on the CSS Pension Plan for late career employees. Hopefully we have cleared up some things for you and answered some of your questions, and you now have somewhat better understanding of the CSS Pension Plan and how it works. But I'm sure you might have some questions later on. If you do, please do not hesitate to get in touch with any of our pension plan consultants. Remember that we are here to answer any questions you may have about the CSS Pension Plan. Our goal is to help you make an informed decision.